Nilesh Shah, Managing Director with Kotak AMC, joins us. Nilesh, I'm literally pinching myself because when I met you on the budget day, or when we spoke on the budget day when markets had fallen, it was a different conversation we had. And today, it's a different market we are staring at. So the budget day price action was real, or today's price action is real? Because somebody got it wrong, somebody got it right.
I think on the budget day, we fell in sympathy with US and Chinese market. On Saturday morning, we had seen US market correcting by 600 points or 2%. On Saturday morning, we were also looking at Chinese market opening on Monday by about 10% down. So the reaction of market was more in sympathy with what happened in US and what was going to happen in China than the budget. Today, when we are seeing clearly market is range bound, little bit directionless in the near term, it's still trying to figure out impact of coronavirus on the global economy. But by and large, coronavirus is benefiting India in terms of lower oil prices. It's benefiting India as countries around the world lower their interest rates and pump liquidity to support falling growth. And the most important thing which can happen is acceleration in disruption in supply chain shifting. Many global corporates would like to shift part of their supply chain away from China. And clearly, apart from Southeast Asia and North America, India also will feature prominently over there. In fact, last week I was reading one newspaper report which showed that Samsung today, at about $62 billion turnover from Vietnam, accounts for 28% of their GDP. Now, such over-reliance has its own risk, but it just shows the power of global conglomerates where they can go and account a substantial portion of GDP of a small country. We just need to get 10, 12 such Samsungs into India, and they can make India part of supply chain or global supply chain, and that will boost growth significantly for years to come. So by and large, market is today keeping one eye on how coronavirus is spreading or getting controlled, another eye on how these benefits are reaped by India.
Okay, Nilesh, though in the interim, we, clearly off late seem to be aligning ourselves yet again with the globe, just as we did on budget day. And, we're back to highs, 12,000 comfortably, etc. But do you sense that fatigue signs would set in soon? Because if you were to map really earnings, we haven't seen a very big recovery come by in Q3.
Undoubtedly, the results so far, which has been above expectations, are more due to tax cuts than the business improvements. But in market today, we are seeing two divergences. One, passive money chasing few stocks where supply is limited or not there. And that's resulting into their stocks getting re-rated again and again. Many of these nifty leaders today are trading at 100% premium to their 10-year historical average. And if this passive money keeps on coming without looking at price or valuation, then probably earnings wouldn't matter in those stocks. On the other hand, there are a set of companies, especially in small and mid cap. In Jan end, the mid-cap market cap was about 17 trillion rupee. That was the same market cap at the end of December 2014, as well as December 2015, give and take 2% here, 5% there. Now, in those intervening 5 or 6 years, these companies have increased their earnings, yet their valuation or prices have not reflected that. So where there is passive money flows, earnings don't matter, at least till such time those flows are there. And where flows are not emerging or not chasing, earnings also don't matter, as valuations have kept on becoming cheaper and cheaper. So as investors, as fund managers, we have to balance between these two aspects on what part of portfolio we give focus on valuation, on what part of portfolio we continue to remain invested in stocks which are definitely catching momentum right now due to passive money.
Max Financials. Of course, the Economic Times today is reporting that Axis may pick up 20% stake in Max Financials. News-based story. It makes sense for Axis to move into Max simply because that's one large bank. They do not have a presence in insurance. They already have a bank insurance tie-up. Amitabh understands the banking and the insurance business. He was heading an insurance company before he became a banker again. So that's what I think markets are speculating. On the other side, you got Aniljeet Singh, who's desperate to get out because 90% of his ownership is pledged. So you have a willing seller or a desperate seller and a willing buyer. That always makes for a perfect marriage. It's only that it needs to be blessed by RBI, because a 20% stake, I'm not sure how the basic law is going to change. Nilesh, without getting into why this stock has moved higher, let's use DMart as a case study. Here's one company which is expensive. It's a great business to be in. When it went public, it was expensive. Purists would say it's a good company but a bad stock to own. But it is up 10x from its IPO price and 5x from its listing day price. So what are the lessons to be learned when you see a classic great business run by a classic great entrepreneur like R.K. Damani? How should one value such stocks, such businesses in the market?
So undoubtedly, in this company, growth, governance, management and promoter are exceptional quality. Now that gives a lot of confidence to investors to stay invested for a longer period of time. However, the prices seems to have moved up ahead of fundamentals. Partly that is driven by limited floating stock, and partly that is driven by committed investors. I had done a back of the envelope calculation before the recent QIP OFS, where about more than 2/3 of the stock was cornered by just one investor. Now, in passive investment as well as active investment, as long as there is one investor who is willing to buy without looking at price or valuation, prices can remain higher and higher. We saw that during Harshad Mehta bull run, where a cement company stock went into 5 digits. We saw that during 2000 technology, media and telecom bubble, where few companies, just by changing their name, went into stratospheric heights. So one needs to evaluate valuation and also keep an eye on momentum. In this particular case, we believe limited floating stock and committed buying has probably pushed prices ahead of valuation, ahead of fair value.
Nilesh, I'm asking very basic questions here. So then what choice do you think right now investors have? Stay with large cap because that's why ETF flows are coming and that's a small market, but those stocks will continue to go higher because we are in an environment of low growth and abundant liquidity? Or it's time now to think and say, look, investing is about buying good companies at a good price. Investing is not about chasing momentum and liquidity, and one should now seriously shift some part of their portfolio from large cap or Nifty 50 ETFs to small and mid cap portfolios or small and mid cap schemes.
Nikunj, this is $1 million question for which there is no right or wrong answer. One can say, Bhau Bhagwan, price is God. Now, as long as passive money continues to come, this 15-20 stocks can still continue to go higher and higher. We know it's the beginning, middle of the bubble, but who knows where the end of the bubble will be. In many of these multinational companies, the Indian companies now contribute 1/3 to 1/2 of market cap, whereas their profitability contribution is between 5 to 7% or even lower. At some point of time, these multinational companies will come to sell or reduce their stake in Indian company, saying, I might as well utilize this money to do buyback in my original company. Unless until that kind of supply emerges, which then brings down price to fair value, I don't see how the stocks will correct, especially when there is relentless buying day after day, week after week, month after month by the passive monies. Now, as an investor, clearly we have to balance between momentum as well as valuation. It's a very, very delicate balance. Markets can remain irrational more than we can remain solvent. So each one will have to take the call as to how much portfolio he wants to allocate to momentum. Undoubtedly, these are quality business run by exceptional managers. We are only talking about valuation here versus the portfolio of small and mid-cap companies which have also done well over last 5-6 years, yet their aggregate market cap has remained flat. So it's a $1 million question for which there is no right or wrong answer. Each one will have to find their own balance.
Sure. Okay. Nilesh, we've been hearing once again, everyone always wants to know when we're going to see this recovery coming in. We're already seeing the price movement, but when are we actually going to start seeing the recovery coming in? Recently, we've been hearing different things from the automakers, the NBFCs. Some are saying green shoots are already visible, some are pushing it back for another 6 months. I ask because a large part of the market is clearly betting on financials, in the wake of seeing that recovery come through. How are you timing it? Are you adjusting your portfolio as, if we are seeing a delay in that recovery coming in substantially?
As of today, if we see data, there is mixed signal on economy. The GST collections are remaining above 1 lakh crore for last 3 months, but IIP numbers in 3 out of last 4 months are negative. The PMIs have started turning positive and staying above 50, but the automobile sales are down 13% for the month of Jan. The real estate investment by household continues to remain poor and falling. It's down by about 50% from their peak. However, power production and power sales both have turned positive after a gap of 5 months. So there are mixed signals emanating from economy, and that impact will be felt in financials also. In our opinion, hopefully recovery will be gradual from here, calibrated from here, as fiscal and monetary policy both starts working together. In this budget, under the FRBM Act, whatever was permissible at 0.5% of GDP, that deviation has been taken. Against 3.3% fiscal deficit, this year we are looking at 3.8%, and against 3% we are looking at 3.5%. So government has pushed accelerator to the full in order to support recovery in growth. On the other hand, RBI has created surplus liquidity in banking system. The current banking liquidity will be almost around 400,000 crore. Now we need to figure out a way how this liquidity moves from banking system to borrowers. On an incremental basis over year to date, incremental bank credit is down by about 4,70,000 crore compared to last year. If this surplus liquidity in banking system reaches out to borrowers, hopefully that gap will be covered, and that will be supporting growth. More important.
Thank you for joining us this morning, Nilesh.